For most of the past decade, the U.S. economy appeared remarkably resilient. Even after major disruptions, trade wars, a global pandemic, historic inflation, and rapid interest rate hikes, the economy continued moving forward. Growth returned, employment rebounded, and consumer spending held up longer than many expected. This resilience created a belief that the U.S. economy could absorb almost any shock. But history shows that resilience can sometimes mask exhaustion. As the economy moves toward 2026, signs of strain are becoming harder to ignore. This is not a year defined by a single crisis or sudden collapse. Instead, it is defined by the convergence of long-term pressures that have been building quietly for years. Interest rates that were once considered temporary are now becoming structural. Debt levels across households, businesses, and government are far higher than in previous cycles. Housing affordability remains stretched, and global trade relationships are more fragile than they have been in decades. What makes 2026 different is not that the economy is broken. It is that the economy is tired. Growth still exists, but it requires more effort to sustain. Hiring continues, but with caution rather than confidence. Spending persists, but it has become selective. Businesses are no longer expanding aggressively. They are protecting margins. Consumers are no longer spending freely. They are prioritizing necessities. This kind of environment has historically preceded economic downturns, not through dramatic collapse, but through gradual erosion. Confidence rarely disappears overnight. It fades slowly, often unnoticed at first. And when confidence fades across households, businesses, and regions at the same time, economic momentum begins to slow. That is why economists are paying close attention to 2026, not because a recession is guaranteed, but because the margin for error is shrinking. On paper, economic growth near 2% does not sound alarming. In many historical contexts, it would even be considered healthy. But context matters. Growth numbers do not exist in a vacuum, and they do not reflect how economic conditions are actually experienced by households. When growth barely keeps pace with inflation, population growth, and rising debt costs, it does not feel like progress. It feels like standing still. Wages may rise modestly, but so do rents, insurance premiums, healthcare costs, utilities, and food prices. The result is that many households feel no improvement in their standard of living, even when the economy is technically expanding. This is where the disconnect begins. Households do not experience GDP. They experience monthly bills, job security, and financial stress. An economy can grow on paper while millions of people feel worse off. When that happens, behavior changes. Consumers become cautious. Large purchases are delayed. Risk tolerance declines. Savings rates increase, not because people are thriving, but because they are uncertain. Because consumer spending drives the U.S. economy, even small shifts in behavior can have large effects. When millions of households pull back slightly at the same time, growth slows further. That slowdown reinforces caution, creating a feedback loop that becomes difficult to reverse. This is why economists are increasingly worried about stagnation rather than collapse. A stagnant economy can quietly drain confidence over time, setting the stage for a broader downturn even without a dramatic trigger. Economic growth does not happen independently of policy decisions. Government choices shape incentives, costs, and long-term outcomes, often in ways that are not immediately visible. Tariffs are a clear example. When tariffs increase, the immediate effect is higher costs for imported goods. Businesses must decide whether to absorb those costs or pass them on to consumers. Either option slows economic activity. Absorbing costs reduces profits and investment. Passing costs on reduces consumer purchasing power. Over time, tariffs also disrupt supply chains. Companies delay expansion. Manufacturers hesitate to commit capital. Prices become less predictable. Even without dramatic price spikes, uncertainty alone can freeze decision-making. Businesses invest less when the future feels unstable. Immigration policy introduces another layer of risk. The U.S. economy depends heavily on labor mobility. Construction, agriculture, healthcare, logistics, manufacturing, and service industries all rely on a steady flow of workers. When labor supply tightens, wages may rise, but productivity often suffers. Costs increase without corresponding increases in output. When tariffs and labor constraints occur together, their effects compound. Businesses face higher input costs and fewer workers at the same time. This does not cause an immediate collapse. It causes drag. And drag is how economies slow quietly. Slowdowns driven by policy are especially dangerous because they are gradual. They do not produce headlines at first. They simply reduce growth potential year after year until the economy becomes fragile. Section 4. Why state-level economies reveal recessions first. National recessions rarely begin at the national level. They begin locally. State economies are more exposed and more sensitive to change. A slowdown in manufacturing hits industrial states first. A housing downturn impacts construction-heavy regions early. Tourism-dependent states feel consumer pullbacks almost immediately. These local effects often appear months or even years before a national recession is officially declared. This is why economists increasingly rely on state-level indicators to detect early warning signs. When multiple states begin to slow simultaneously, it is rarely coincidence. It often signals that underlying economic forces are weakening. In 2026, this matters more than ever because the U.S. economy is highly fragmented. Some states rely heavily on technology. Others depend on energy, manufacturing, tourism, or trade. When one sector weakens, entire regions feel the impact. National averages can hide this reality. A few strong states can mask widespread weakness elsewhere. But regional stress eventually spreads, especially when labor markets and housing markets begin to soften. These 10 U.S. states most economically exposed heading into 2026. Before diving in, one clarification. These states are not doomed. They are more exposed to downside risk because of how their economies are structured. Exposure means that if national conditions weaken, these states are likely to feel it earlier and more intensely than others. 1. Texas. Texas is often viewed as an economic powerhouse, and in many ways it is. Strong population growth, business-friendly policies, and a diversified economy have helped Texas outperform national averages for years. However, that same scale and growth make Texas highly sensitive to economic shifts. Texas remains deeply exposed to energy markets. While the state has diversified beyond oil and gas, energy still plays a central role in employment, investment, and tax revenue. A slowdown in global demand, falling energy prices, or trade disruptions can ripple quickly through the state economy. Construction is another vulnerability. Texas has experienced a massive building boom fueled by population growth and migration. If higher interest rates persist and housing demand cools, construction activity can slow sharply. When construction slows, job losses tend to follow quickly. Texas doesn't create recessions. But when national momentum weakens, Texas often amplifies the cycle due to its size and exposure. 2. California. California's economy is massive, complex, and globally influential. It leads in technology, entertainment, agriculture, and international trade. But size does not equal immunity. One of California's biggest challenges is cost. Housing, taxes, energy, and insurance costs remain among the highest in the nation. High costs reduce disposable income and limit consumer spending, even when wages are relatively high. The tech sector, once a constant growth engine, has become more volatile. Hiring cycles are less predictable, and capital investment is more cautious. When tech slows, it impacts everything from office real estate to local tax revenues. Population outflows add another layer of pressure. When residents and businesses leave, the tax base weakens, making it harder to fund public services during economic slowdowns. California often feels downturns earlier because its growth engines are tightly tied to global capital flows and investor confidence. 3. Florida. Florida's economy thrives on growth, migration, and tourism. Those strengths also create vulnerability. Tourism is highly sensitive to consumer confidence. When households feel uncertain, discretionary travel is one of the first expenses to be cut. Even a modest pullback can have outsized effects on employment and local revenue. Insurance costs represent a growing structural risk. Rising property insurance premiums strain household budgets and increase business operating costs. When affordability worsens, consumer spending weakens. Florida has also experienced rapid housing price growth. If housing demand cools, price corrections could slow construction and reduce household wealth, further tightening spending. Florida often performs extremely well in expansions, but that also means it can slow quickly when sentiment turns. 4. New York. New York's economy is deeply tied to finance, professional services, and global markets. That connection brings wealth during booms and volatility during downturns. Financial markets drive employment, bonuses, and tax revenues. When markets become unstable, income volatility increases. That can quickly reduce spending in housing, retail, and services. Commercial real estate remains a major concern. Office vacancies, declining property values, and refinancing risks create pressure on banks, investors, and municipal budgets. New York also faces population outflows, which reduce long-term growth potential and complicate fiscal planning. New York doesn't need a national recession to struggle. Financial volatility alone can slow the state significantly. 5. Illinois. Illinois faces long-standing structural challenges that make it vulnerable during economic slowdowns. Fiscal pressure is persistent. High pension obligations and debt servicing costs limit flexibility during downturns. When revenues slow, difficult budget decisions follow. Manufacturing still plays a meaningful role in Illinois' economy. Manufacturing is highly cyclical and sensitive to interest rates, global demand, and trade policy. Population decline adds another layer of stress. A shrinking tax base makes recovery slower and limits growth even when national conditions improve. Illinois often enters downturns weaker than other states, making recoveries longer and more difficult. 6. Michigan. Michigan's economy remains closely tied to manufacturing and the auto industry. While diversification has improved over time, auto production and global demand cycles still dominate economic outcomes. When interest rates rise, vehicle demand often falls. When global growth slows, exports weaken. These forces can reduce production quickly. Supply chain disruptions and transitions toward electric vehicles add uncertainty. Capital investment decisions are cautious, and workforce transitions take time. Michigan tends to feel global slowdowns faster than service-based states, making it an early indicator of industrial stress. 7. Ohio. Ohio sits at the intersection of manufacturing, logistics, and traditional industry. That positioning makes it sensitive to changes in trade, transportation costs, and industrial demand. Manufacturing employment has declined long-term, leaving the state more vulnerable to cyclical shocks. When demand slows, job losses can appear quickly. Population growth is relatively slow, limiting consumer-driven expansion. That makes recoveries more dependent on national momentum. Ohio's economy often mirrors national trends, but with less cushioning during downturns. 8. Pennsylvania. Pennsylvania's economy is diverse but uneven. Some regions thrive, while others struggle with aging infrastructure and declining industries. Manufacturing, energy, healthcare, and education all play roles. But slower job growth and population stagnation limit expansion. Infrastructure challenges increase costs and reduce competitiveness. During downturns, deferred investment becomes more costly. Pennsylvania tends to experience slow recoveries, especially when national growth is modest rather than strong. 9. Nevada. Nevada's economy is one of the most cyclical in the country. Tourism and hospitality dominate employment. When consumer confidence weakens, travel and entertainment spending are among the first areas to decline. Housing volatility adds risk. Rapid price increases, followed by slowdowns, can create sharp corrections. Nevada often feels recessions earlier and more intensely than other states, but also recovers quickly when growth returns. 10. Arizona. Arizona has experienced rapid growth driven by migration, construction, and housing development. That growth masks vulnerability. Construction-heavy economies are sensitive to interest rates. When borrowing costs rise, projects slow or stop. Housing affordability pressures reduce demand, even as population growth continues. Arizona's economy benefits greatly from expansion, but that also means it must adjust quickly when momentum slows. Most people imagine recessions as sudden events. In reality, many downturns feel slow and confusing. Hiring freezes replace layoffs. Wage growth stalls. Hours are reduced. Promotions disappear. Consumers quietly cut back. Businesses delay decisions. Confidence erodes. This is often called a rolling or silent recession. Different industries slow at different times. Different regions experience pain unevenly. By the time a recession is officially declared, many households have already felt its effects for months. This is what makes slow-motion downturns dangerous. They do not inspire urgency, they encourage complacency. For workers, this environment rewards stability over risk. Job security matters more than rapid advancement. Emergency savings become essential. For homeowners, price growth may flatten. Selling may take longer. Equity growth slows. For investors, volatility increases. Regional exposure matters more. Fundamentals matter more than hype. This is a period where discipline outperforms speculation. The U.S. economy in 2026 is not guaranteed to collapse, but it is fragile. Growth is slower, risks are higher, margins are thinner. Recessions rarely begin with headlines. They begin with complacency. Understanding the signals early gives people time to adjust. And preparation is the difference between reacting late and navigating downturns effectively. Thanks for watching.